All right, guys, this is going to be very, very important if you're a real estate investor. This bit of information, what I'm about to teach here, this is going to be the use of indexed universal life insurance policies for real estate investors. Wholesalers, this applies to you. So whether you're flipping, you're wholesaling, you have rentals, you're doing the BRRRR strategy, I ask a lot of investors when I speak with them about where they put the money after they actually profit from a deal. So the typical investor will say, well, I'm down here, I'm doing my flip, doing my rental, I profit from it. Let's say you do your flip or you do a rental and you have cash out, you do a cash out refi going into the bank, or you have rental income, it's going into your bank or your entity, right? Your business account. Flips are going right back into your bank, and all you're doing is you're going back out, and then you're doing, you're acquiring the next rental or you're acquiring the next flip. And who's profiting the most from this, guys? The bank is. Essentially, they're pirates. What they're doing is they're taking your money. This is almost like money jail, right? They're taking your money, they're lending it out, right? They're lending it out. They're putting their most important money in bank-owned life insurance. So what I'm about to show you is even if just a portion of your profits from your flips, your rental cash flow or your cash out refis, why don't we just reposition that from the bank and the pirates over here, essentially into now your IUL policy, or let's just call it your own bank, right? Because the bank's doing the same thing. They're lending it out, they're borrowing the money. It's true OPM, they're using your money, true other people's money, right? And they're putting in bank-owned life insurance. So why not utilize the IUL and reap the benefits for yourself, guys? So let's put the profits, even a small portion, let's reposition some of the profits into the IUL policy. Now, why does the IUL policy, why is this such a good home for your money? So that's what I'm about to show you. So when structured properly, you get 85 to 95% of the benefits come from out of knowing how to properly structure this, which is what I specialize in. So what we want to do and why the IUL is so beautiful, first of all, it is an insurance policy, but let's focus on what it does, not what it's called. So what we do is we minimize and we shrink down this death benefit. So that only takes up a small portion of the policy, right? But that small portion is going to get you all sorts of amazing benefits, which I'm going to speak to here, of keeping your money liquid, of keeping your money safe, which means no matter what happens in the market, you can never lose it. Unlike a 401, an IRA, if your money's in stocks, heck, even if your money was in the bank over here earning 0.5% and inflation's at 8, 9, 10%, you're still losing. So over here, your money stays liquid, it stays safe, you can never lose it no matter what happens in the market. Say another 2008 happened, you wouldn't have lost a dime. You earn a respectable rate of return on your money, historically 7 to 10%, right? And all your earnings are tax-free, guys. You can borrow the money to yourself tax-free. It grows tax-free. It can pay you a retirement income, structure it as a loan later in life, tax-free, which I'm going to show you here on the next page. And you get an amazing death benefit also left behind to your beneficiaries if you were to pass away, or God forbid something happened to you while you're alive, like a chronic illness, a terminal illness, you became disabled. You can actually access a large portion of that death benefit, so you use it while you're still alive if you can't have an income for yourself or for your family. So we shrink down this death benefit, which maximizes room for cash to go into the policy, or let's call it equity to use a good real estate analogy. So what we want to do, let's just think of this as an apartment building. We're going to fill this up with cash for, let's say the next 5 years, or ongoing throughout, the next 10, 20 years, and I'll show you this on the next page. So what we want to do, guys, you're down here nice and happy, right? So you go out, you do your next flip, your next rental, and instead of going into the bank, let's say we're going to fund the policy, right? Then when we need money, we're going to take a loan back out to ourselves. What are we going to do, guys? We're going to go do our next project. We're going to put the money back in, and we're just going to do this nice circle right here. And all this while, cash is going to just grow inside the policy. So indirectly, essentially, you have tenants paying for your IUL policy, you have your flips paying for your policy, some portions, you have your cash out refis, some of that paying for the policy. So again, this is so important. Right here, you're missing a huge opportunity, right? Over here, our money is going to stay liquid, it's going to stay safe, you're going to get a respectable rate of return, it's going to grow tax-free, and technically, this equity, this cash inside your policy actually never leaves the policy. So when you do take a loan to yourself, it's just a collateralized loan against the value inside here that the insurance company gives you. So you can actually, let's say you're earning 7% this year on the cash value that's in here. When you take a loan to yourself, it might be at 5%, right? So your money is still growing. The whole account principal is still growing in here while you take a loan out to yourself. So now you're almost like your own gap lender or hard money lender. So you're actually making like an arbitrage spread. When you make a loan to yourself, then you're taking the money and you're going out and you're buying another income producing asset, which is making you more money. So now your money is working for you smarter and harder. It's working for you in two places. You're taking your profits, putting your principal back in, and you're repeating this cycle. And that is what is so beautiful. Now, what I'm going to show you here on the next page is what an example illustration looks like for a hypothetical person, funding the policy with flips and rental incomes over, let's say, the next 20 or 30 years. Okay, so this is absolutely beautiful right here. So this person was just, let's say I said a male, started at 40, so 41 would be his first year. So for these first 7 years you see here, he funded the policy with $25,000 a year. So that could be a portion of, let's say, if he has rental properties, he's doing cash out refis, maybe you did a handful of flips that year. All you're doing is repositioning, whether you have some money in the bank right now or you did a cash out refi, all you're doing is repositioning money you have coming into your life and you're putting it inside the policy, right? So for the next 7 years, this person was an active flipper. Maybe they're doing 3, 4, 5, 8, 10 flips a year, right? It's very realistic to get $25,000 a year if you're an active real estate investor into an IUL. So a combination of, flips and rentals, cash out refis. Then going forward, maybe they wanted to focus just on rentals, right? So they built up their rental portfolio. Now all they have is rentals, even a small portion of their positive cash flow funding the policy. So indirectly, tenants are paying for you to grow this policy, which I'm going to show you here now. So look down here. This is your planned premium outlay column. So at the end of 10 years, you have $218,000 of premium you have paid in. Now, if you look over here, you actually have an account value of $272,000 and a surrender value. That's basically what's called your liquidity that you can borrow from column. You have $268,000 in there. Guys, you've only paid in 218. You have 268 available. So even on, if all you did is just funded the policy once, $25,000, and you were to pass away, the net death benefit to your family, even if you just paid one premium, would be $500,000 of tax-free money that will get left behind to your family. So what we're going to do is we're going to project forward in time now. So you have funded the policy from 40 down to, let's say, retirement age. So now you're 60, 20 years later, right? So you have totaled $362,000, which you have paid into the policy over the course of 20 years. From here forward, you never pay another dime. But because of the policy over here in this illustration is earning 6.91% per year, that's the illustration. That's tax-free growth that is taking place, compound interest. Look what you have at the end of 20 years. $781,000, this is illustrating in the policy of tax-free money with a $1.2 million net death benefit. Now keep in mind, you have only paid in $362,000. Again, you have $781,000 inside of the policy. Let's project forward down to now you're 30, at age 70. Again, you never put in another dime. Look what we have over here. 1.6 value, but now the surrender value has gone down. Why is that? Because I set this up at age 60, so let's say 61, because the account value throughout these years has grown so large. You're taking structured as a loan $87,998 almost $88,000 a year. That is net, net, net. You don't pay a dime of tax on that. You're taking that as essentially a retirement income to yourself. So you're starting at 61. All this is over here is the next page. It goes all the way down to your 85. Now you could actually take less, and that will actually run out longer. Or you don't even have to take any of this. I'm just showcasing what the possibilities are. If you didn't take a loan, obviously the account would continue to grow. Essentially, all you're doing is you're drawing down off of the cash. So guys, $87,000, almost $88,000 a year in this hypothetical situation, just because all you did is reposition some of your flip money, some of your rental income, some of your wholesales, some of your cash out refis into the IUL, and you let tax-free compound growth take effect and work for you. So again, this is a tax-free loan structured to yourself, guys. And if you look over here, obviously it goes to 85. So there's the last year, but look at this. The surrender value starts to go back up because you stop taking the loan again, so it actually starts to grow again later on in your life. And at any point, if you were to pass away, this column is actually how much would get left behind to your loved ones. The surrender value, at any point, if you needed a loan to yourself to go out and buy more deals, that's basically your borrowing power. So you could take a loan to yourself, let's say, over here, year 7, you wanted to take advantage of a good deal. You need 100,000. Okay, well, you have 183,000. You borrow 100 to yourself. And again, as you borrow, remember what I said, the account can actually still, depending upon what's going on in the market, if this is growing at 7%, since the money actually never leaves the account, and you borrow a loan at 5%, again, you're making that arbitrage spread. You're going out and you're buying another rental or cash flow or something that's making you more money. So guys, if you were to have to net almost $88,000, that would be like you would have to gross $120,000, right, to net 88. So look at that. You would have to net $120,000 per year to net this right here. So what rental property or multifamily do you know that if all you did, right, in this hypothetical illustration, had paid in $362,000, almost 20 years or more of your life, you have a net income of $88,000 here in this illustration. This cash flows better than rentals, guys. What if you had a portfolio of IULs, your flips and your rentals, your cash out refis, your real estate deals? If you put 30, 40, 50% into different IULs, now you can actually own more than one IUL. What if you started to build out IULs and almost consider them like your own apartment building? So you started to fund the IULs and you treated those like rentals, because you can see what happens over here over time. And all this net death benefit, remember, that all gets left behind to your loved ones too, just like a piece of real estate, guys. So start to think a little bit differently where you're putting your money from your real estate deals. And I look very closely at the IULs as another technique or another strategy. So if you're interested in learning more about this is exactly what I specialize in. Reach out to me. Let's get a conversation going. Let's discuss, how many rentals you have, your cash flow, how many flips you're looking to do, and how we can incorporate the IULs into your overall real estate strategy. I'll talk to you soon. Take care.